Alrighty. Well, it says we're live. I'm going to give it a second because I've started flapping my gums before and it cut me off. So, what's up, everybody? I am Russ, and we're here on the old Dapper Dividends podcast with Jeremy from dividendstockpile.com. And I was on Twitter, saw him put a post that he's building a REIT portfolio. You want to tell us you're building a REIT portfolio on M1?
Yeah, absolutely. Hey, everybody. So my main accounts are with Fidelity. That's where I have all my dividend accounts and whatnot. But about a year ago, I started getting into M1 as well, just to test it out to see what it's all about. I love the fact that you can just set up a portfolio, and every time you buy something, it automatically spreads it out over the different stocks. So I have a small dividend portfolio there that I put a little bit of money into every single week. But I've been thinking about focusing more on real estate investment trusts, REITs. And I follow Brad Thomas on Twitter and YouTube, and he's like the REIT analyst extraordinaire. And so as I read his book and listen to him more and more, I just see the benefits of REITs. So I've decided to build out a separate REIT-only portfolio in M1. And so far, I've picked about 17 different companies. I'm looking to just dollar cost average in every single week going forward, to put a certain amount of money and just let it build up over time. My timeline for my dividends is somewhere in the 5 to 10 year range when I'm going to start using them. So I like the added the higher dividend rates that REITs can give you. So yeah, I'm starting to build that out there.
It's like your own. It's like your own ETF, right? Your own REIT, the dividend stockpile REIT ETF.
Exactly.
And
that's so one is you just throw it all in there and it just does it for you, which is great. You don't really have to think about it once you do your research and set it up.
That's funny. I didn't realize. I've never been on M1, but so you're saying you just pick the companies, and then if you put $100 in, you choose the distribution or equally, or if you wanted to, and it'll just spread it out amongst all of them.
Yes. When you set up the portfolio, you tell it certain allocations. Let's just say I want, realty income to be 30% of that portfolio. So every $100 you put in is going to put $30 in that based on your allocations.
Nice. Yeah. All right, cool. All right, well, so we're gonna do this. I'm gonna have Jeremy, since he's the guest. He's he'll go. I'm the home team, so I'll bat last. But I'll have him just go through real quick overview. I know we have a lot of beginners that watch, and for those of you watching on the replay, we'd love to hear what you think of it. But we're gonna go kind of just overview, really high level. We're not going to get into the weeds with like financials and whatnot, but just pretty much letting you know the ideas of why we like these companies and why we think they're a buy right now. So as you're talking, I'm going to probably fumble through this for a second. I'm going to try and use and we don't know, by the way, I don't know. We didn't share our picks, so we may have some overlap here. So it'll be kind of cool to see, but I am going to use good old Simply Safe Dividends to just kind of scroll through it as he is talking. So with that being said, if you want to just go ahead and I'll jump in and get this working. If you want to start with your first one, good sir.
It's good. I'll let you know what my first pick is, and you can pull it up while I'm talking about it. But the first one I wanted to talk about is Digital Realty Trust, ticker DLR. It's a data center REIT. Hopefully everyone's heard of it before. It's one of the larger data REITs and one of the larger REITs out there in general. What I like about it is all the major corporations. So they think about all the different digital information that we have. It has to be stored somewhere. And generally speaking, that's the cloud. And DLR, Digital Realty Trust, operates, data centers that basically host all these clouds that we always talk about. And so I like them for a couple of reasons. One, they're a leader in their space. They have a very safe dividend, as you'll see here. And it's growing extremely fast. Additionally, all three of my picks today are what I consider undervalued. So it'd be interesting to see what Simply Safe has it for the valuation. But based on my calculations, they're all good deals right now. So that's why I wanted to mention those as buys today.
They do have it undervalued. So you can see this, I'm assuming. So yeah, the yield is above the 5 year, and the price to AFFO is below the 5 year. So yeah, definitely undervalued.
Yeah. So I like that one a lot. It has a lot of growth behind it. It's very safe. Another website I use outside of Simply Safe Dividends is a place called All REITs. It's ALREITs. And they do a great job breaking down the quality of REITs. They give it a score similar to Simply Safe Dividends based on 5 different criteria. And so it scores really well. I think it scores 100 on allreits.com as well. So DLR is a very high, top quality company.
Let's see. I'm bringing that up right now. Forgive me, people. Forgive me. I'm sharing the one tab. Let me do this. See if I can share. How do I jump to the other tab? I've never used all REITs, so let's see.
Yeah.
Here.
So while you're doing that, yeah, I threw that one on you. Digital Realty Trust has 284 facilities in 48 different areas, and they're spread across 23 countries, not continents. 23 different countries. So it's a global player. So there's definitely a lot to like. They have 4,000 customers, and they do a lot of the cloud you see. Looking at their investor presentation the other day, they're the 7th largest REIT in the U.S. So a very big, high quality name. There we go.
Yeah, looks good, man. I like this. I've never heard of this site. So allreits.com.
The payout ratio good. The yields are higher than their average, so that means they're undervalued right now. As you see, the dividend growth is exactly what we want to see. Every 4 quarters, it pumps up again. Yeah, it's a really good, high, top quality one, and the yield is pretty good right now. So that's my first pick.
3.83. All righty. So I'll pop on to Simply Safe as we start up the second one here. So what's your next pick? Yeah. By the way, DLR, I like it. That'll tie into one of mine, but I'll save it. So anyway, I'll try not to cut you off. What's your second?
Oh, what you got? All right. So the next one I have that everyone should take a look at is Simon Property Group, ticker SPG. So basically, they're one of the larger and higher quality mall REITs. And so I'm sure everyone's thinking, well, no one goes to the mall anymore, that type of thing. But you'd be surprised. You go to one of their malls on a weekend, they are packed. And the nice thing about Simon Property Group is they have what they consider A quality malls and outlet malls. And so we're not talking about the little suburban malls that no one goes to, there's crickets in there. These are bustling ones. They have restaurants, they have movie theaters, they have the shopping itself, they have the high-end stores at their location. And so if you're going to be in that space, Simon Property Group is one of the leaders. And so you can see here on the screen, they did have to cut their dividend back during the pandemic. And that was basically a good use of the company's money. We didn't know how bad it was going to be, and they wanted to conserve capital during the worst of it. But as you see, right as 2020 was ending, they started pushing up their dividend again. If you see on the right-hand side of that screen right there, that chart, it was flat for a couple quarters, then it shot back up, and it's already halfway back to what they cut it. So they're actively raising their dividend and multiple times a year to get it up back to where it was, and hopefully even further along. The leader, his last name is Simon. I forget his first name, but he is one of the best.
David Simon, I think.
There you go. He's one of the best out there right now when it comes to the quality of the properties and his understanding of the industry. So as you see, the yield is higher than the average even after the cut, and they're growing at again.
Dividend yields 37% above the 5-year average, 6.56.
There you go.
Nice. Yeah. And the price, I always tell people this is kind of like the PE, but because it's a REIT, we look at price to adjusted funds from operations instead. So it's way below the 5-year average.
Exactly, and that's even with the pandemic numbers going in there. So I think we're in a good spot with this one going forward. So. Once in a generation event, you don't expect that to happen again. So they should be able to build back up, and people are shopping again, especially with back to school coming up, with the holidays coming up. People are going to be out there shopping. They just want to get out and do something. So I see that one going really well. The last one I have for today is actually one I don't own yet. It's going to be one that I'm going to be adding to my REIT portfolio that we were talking about at the beginning. And that one is Store Capital, STOR.
Plug it in here. Yeah, Store. I own Store in retirement account.
There
we go.
Yeah. So Store Capital is, it just as the name says, a single tenant operational real estate. So what they do is they buy the single tenant freestanding buildings that we all go to. And they have quite a lot of properties. I think it's somewhere in the 2,500 different property range. So they have locations all throughout the United States, and they're growing really quickly. A very similar business model to Realty Income, ticker O, but Store Capital is a little bit newer. So you don't have quite the level of dividend history that you do with Realty Income, but they're growing it a little bit faster, and the yield is a little higher. So I like Store a lot right now.
Nice. Looks good. Yeah, looks good. Let's see what old Simply Safe. Oh, I got to stop sharing. I got to do this better. I got to do it better, everybody. Let's see. What are we doing? We're going to, let's see. We're on Store. Apologies, everybody. As your host is fumbling his way through it. Okay. Oh, not Store. Store. There we go. 70. Yeah. So again, I own this one too in this self-directed IRA, I believe.
Yeah.
And
the majority of my REITs are in my IRA too, because obviously, for everyone that may not know, REITs, you get the dividends are taxed at your normal tax rate minus a 20% deduction for the next 4 years. And so if your tax bracket is 25%, obviously you're going to pay a lot more if you have it in a brokerage account than you would for a retirement account. And it's a qualified dividend, which is your typical companies like your Cokes and things like that. You're only getting charged either 0 or 15% taxes on your dividends. So take that in mind when you're filling out a REIT portfolio, and something like an IRA or a tax deferred account is definitely the better place to put it. But in my situation, we're trying to use the money from our dividends prior to retirement. So we're starting to build it out in our brokerage account as well.
Yep. Yeah, definitely a very important point there. And it's a little bit of a lot of people don't realize that, if you don't need that money right away, that it might be best to just hold those, because, right, they have to pay out 90% of their income or their earnings, right, in the form of the dividend in order to keep that tax-free status. So we're paying the tax. They're not paying the tax. It's just getting passed through on us. So that's why REIT dividends are non-qualified. Yeah. But yeah, it looks good. 7 years of growth for Store Capital. And yeah, they are very similar to Realty Income. And going ex-dividend June 29th. So they are not a monthly company. That is right. But yeah, you're right on the timeliness. The dividend's 23% above the 5-year average. So yeah, 5-year average for 4.55, currently 5.59. And yeah, by all intents and purposes, my brain was saying, hey, make the camping is intense joke. And I was like, no, don't do it. That was the two sides of my brain fighting together. That's what happens. So anyway, all right.
Those are my top three. My bonus pick would be IIPR. I won't go into the details of it yet. Well, maybe we'll leave it for the comments later. But that would be my next choice. It's obviously a lot riskier, but it's one that I'm regularly adding to. So maybe we can talk about that one later.
Well, funny you should say that, because my first one, we'll just jump right into it, is going to be IIPR. And I actually did add to this position earlier in the week at $89 a share. So, I think it's just a lot of short-term volatility and people kind of panicking. So what happened is one of their tenants, King's Garden, I think it was about 8%, I think, and they defaulted on their July rent payment. So there was a short report put out in April by Blue Orca, is it? I know it was a color and a giant, I don't want to say fish because the orcas are mammals, right? They're not fish. So I think it was Blue Orca put out the short report, and they kind of said that some of these tenants it's going to be a little bit risky. But I did buy IIPR, and let me share the old screen here. So, I think a lot of times we can take some short-term volatility, and if we have the long-term outlook in mind, that we can get some good opportunities here. But Simply Safe did downgrade them, I believe, from a 60 to a 50. So it was still borderline safe, but it's just at the lower end of the bucket. But yeah, so they have a borderline safe dividend safety score. And let's see here. So again, what they do is they rent out property. They do a lot of sale leaseback, meaning that they buy the property from the cannabis operator and then they rent it back out to them with like a 10 or 15-year lease. But what Blue Orca said that they were doing was they were way overpaying for the property, which was kind of infusing the tenant with cash and then charging a higher premium for the rent. So they would just start getting some of that back, kind of like a marijuana bank is what they were calling them. So they're going to say that's going to work until it doesn't. And if these companies can't be profitable, then that's going to be really bad because they're going to default, which it just looks like it started happening. So this one is pretty risky, but their last dividend growth was 28%. And 4 years they've been growing it, currently paying $7 per share. And they're like, I think 90s, what was it? 96. I think they went back to, let's see, or 95 blocks. So they were at 89. And as far as the timeliness goes, yeah, again, buried. It's crazy that they were as high as $286. And it stinks that I wasn't psychic because I could have sold at the top. But, unfortunately, we can't predict the future. So I wasn't buying up there. And let's see, the shares that I do hold. So, yeah, anyway, you can see the current yield is 138% above the 5-year average. The price to AFFO is below 5-year. So they are definitely a dividend company, a REIT that's on sale. And this is what I was doing. Yeah. So you can see I have 11 shares at $163.56 a share. And, we're down 41%. I'm probably going to buy a few more. So we don't have anything breaking the bank, but it's bringing in $77. And that is 1.7% of the income. So, that would suck if that went away, but it's not, not the end of the world. So first one for me is IIPR, and I'd love to talk more about it and get more into it with your thoughts. But the second one that I got is Equinix. I'm talking. See, I'm doing this wrong. I am talking and typing, and here we go. Equinix. Dividend safety score of 86. So basically what Equinix does is they're a business that rents out space for other businesses to host their servers. And I think that a lot of people with REITs just focus so much on like the retail and just like kind of like store realty income, realty, which is fine. But, the world is going to just keep being way more digital. And I think companies like Digital DLR and Equinix, I think they're great places to look. Now, one thing I want to point out is the current share price is $653. And to a lot of newer people, that might sound like it's a lot of money or way overpriced, but you always have to look compared to itself. And I don't know the number. Let me see. They don't have a lot of shares outstanding. It's probably in the millions. Yeah, they only have 90 million shares outstanding. So not a lot of shares, but this is a company that, again, I don't own them. I'd be curious to know if anybody out there does own them. And as far as timeliness, just a little bit on sale. Their dividend yield is about 9% above the 5-year average, and they're just slightly below the price to AFFO. So, they're at the lower end of the 52-week range. They've been as high as $882 a share. And yeah, if anybody out there owns Equinix or DLR, we would love to hear it. Love to know why you do own them. So yeah, they do say reasonably valued. So it's not a screaming buy, but I do think it's an area that, we should focus on and start looking at. And then my last one is going to be, let's see, I don't think I can just share that tab. So if you wanted to own all of them, and this one, I think this is going to be a bit of a cheat code for this next one. And I'm sure Jeremy's well familiar with this. he's BSing us as I'm trying to so I got all my tabs down here and I'm trying to do 17 things at once. So let's do this. It is going to be the VNQ, the Vanguard Real Estate ETF. Now, this holds well over 100 companies, as we'll see here in a second. I think it's like one, I don't know. I don't want to put words in their mouth. But anyway, an ETF is an exchange traded fund. You're going to pay Vanguard a small fee. In this case, it is 12.12%, meaning that for every $10,000 invested every year, you're going to pay $12 to Vanguard, which is pretty low compared to most of the other brokerage houses. And what I like about that, and we'll just get cut right to the portfolio composition. 170. So they own 170 stocks by paying $94, right? What was it? $94.51. You can get instant exposure to 170 REITs, which I think is really cool. And they are pretty spread out. They show, and everybody feel free to go on Vanguard. They're really easy to navigate. You can do a little more in-depth research, but the specialized REITs, which is what DLR and Equinix are, they're specialized REITs. That makes up 38% of the portfolio. And we have industrial REITs at 11% and residential REITs even. So you can get into the resis for 15%. But the top holdings, aside from their real estate index fund, individual companies, is American Tower, Prologis, which in my neck of the woods, we do a lot of work at Prologis buildings around the Chicagoland area. And here it is. Look at that. See, Equinix is right there. So you can get exposure to Equinix. And one of our favorites is Realty Income. But then look at this, getting exposure to DLR as well. So these are the top 10 holdings. So I think companies like this, and then, yeah, you can, not the disclaimer, there's a tab here somewhere where you can view. There you go. So you can just keep going down the line and see. There it is. Check that out. Simon Property Group is number 11. And just, it's fantastic. I love ETFs like this. If you just want, you don't want to have to think about it, pay Vanguard, let them do the heavy lifting and put the money where it needs to go. So that is that's my top 3. And I guess, like I said, it's a little bit cheating. Ended with VNQ, but yeah.
Great
So
choice.
that's it. What about VNQ? What do you think about owning REITs like that or ETFs?
Yeah, the ETFs are definitely a nice way to go if you don't want to put the time and work into figuring out which specific ones, and if you don't want the risk of allocating a large percentage to any one REIT. You want to spread out your bets, if you will. VNQ is one of the top REIT ETFs out there. So I think it's a great pick. And that 0.12% expense ratio is bottom of the barrel. You can't get much better than that for a REIT ETF. The only negatives I think about the ETFs is one of two things. One, the yield is a little bit lower because you're spreading out your bets along with some low yield and some high yields, but it averages out pretty low right now. And the other part is because 170, there might be a few dogs, if you will. So you're
absolutely
you're buying a little bit of everything. So there's going to be some that are fantastic and some that don't do so well. But the point of an ETF is you don't have to choose. You just get all of them, and you do however the market does for REITs. So I think
so with everything, there's a pro and a con to everything in the market. There is nothing that is no risk and foolproof, because if there was, everybody would just be into it and nobody would lose money. So there's a pro and a con to everything. So all right, let's 22 minutes, man. That went longer than I thought. Awesome. I hope you guys got some value. And now let's open up the floor. Let's talk for a good 40 minutes or so. But yeah, Caitlin, who dude, she's super knowledgeable. I've been seeing her around social media and on other people's comments. And Caitlin, you need to start your own channel because she shares a lot of good information. But she tried to guess the 3 before, and she got SPG, Prologis. Technically, she probably got them all because I went with VNQ, and I'm sure all of these are in VNQ. So nice job. You did get Simon Property Group. And then Steve put his hat in before we started, and he picked Store. So there you go. Stag, he missed. I know I joked around. I'm super tall, athletic. Super, oh my God, single tenant acquisition group. So they're kind of like Store, but they do industrial warehouses. And I love that. That's in my, So
I like
So
them too. The only problem is their dividend increases have been really small lately for
Stag.
And so that's the only thing that's holding me back. I do have a little position in that one, but I'm not adding to it because I just want to see if they can. The industrial REITs is a very hot market right now, and there's a lot of players and a lot of competition, and so we'll have to see how that plays out.
Yeah, you're right. Their dividend growth is only 0.7% last in January. 5-year CAGR is 1%, but 10-year is 7%. But they had a few big increases coming out of they started right in 2010 or 11. Mm-hmm. But yeah, they're a monthly REIT, by the way. Stag is. So Steve wanted to see who got more. You guys tied. You each got 1. Here we go. All right, Michael. This is my guy from Sweden who I did the last video for. What's up, Michael? I hope you're still on since he put that comment like 20 minutes ago. So we'll move further to try and get caught up. Camarai Vicis is only REIT, but he likes Store. Oh, yeah. Vici, they acquired MGM Growth Properties not too long ago. They merged. So basically, if you own Vici, you're pretty much owning, I forget what the number is. It's a high percentage of the Las Vegas Strip. I mean, I don't even know. It might be 80-90% of the casinos on the Las Vegas Strip you're basically owning. So Vici, interesting one.
Big fan of Vici.
Which I do own that too.
Yeah, I have quite a large position. I think it's like 300 shares or something like that. Big fan. So yeah, good stuff.
Way more than I think I've got 9 or 10. Shamir, Canadian guy. Shamir, what's up? Here, what website are you on? So if you're watching, Michael, we looked at simplysafedividends.com and allreits.com, ALREITS.com, which I'll put a link to that when we're done. He has Canadian REITs. That's interesting. I'm not very familiar at all with Canadian REITs.
I know that there's a couple good ones. I can't think of them off the top of my head. So Shamir, if you're still there, it'd be great to get a couple. But I know there's some really good ones up there as well. So yeah, that'd be great to get some more insight.
And I'm typing the comment for Mikhail, and then Simply Safe Dividends. Well, everybody should know. Yeah. There we go. Yeah, Camera answered. Cool. Now we're getting caught up. Talk about IIPR. We did talk about IIPR. If anybody wants to throw in their, if you're investing in IIPR, it is a bit risky, but I think it'll recover. And I think as regulation really starts to set in, I think the big bugaboo, right, is that it's not federally regulated. Still, it's federally illegal, but the states are. So all of IIPR's facilities are all state approved. So it's legal in the state, but it's illegal federally, which means that the big banks aren't going to loan money to these companies. So that's why they were being accused of being a marijuana bank. But yeah, look of MPW Hospital REIT. Yeah, MPW. I think somebody brought this up last one. I'm not terribly familiar, but I will look. Hey, let's look at it. We'll use all REITs.
Yeah, well, while you're doing that, yeah, I own MPW. I think it's fantastic. I love that they're one of the only hospital REITs out there, and they have REITs. They have properties both here in the U.S. and in Europe. So basically, hospitals are a necessity, and you're not going to see a hospital necessarily close down every day. So it's long-term tenants that have, obviously a lot of revenue coming in. Medical Properties Trust owns the largest number of hospitals in the world of any other REIT. So I like it. It gives me some diversification into the healthcare space. I like it. It's a score of 90. The only thing they have is a lot of debt. But, REITs all have a lot of debt, so that may not necessarily be a bad thing.
Yeah. So since 2009, coming out of the Great Reset, looks like they might have cut heading into the Great Recession. So that's something to keep an eye on. But yeah, that's really interesting. And this is cool, man. I like this.
Yeah, it's a good
financial
website.
Reports. Yeah, I'm going to be looking at this. Nice. Shows their
99.5% occupancy. I mean, that's huge.
Yes. Yeah. That's almost realty income numbers, right?
Yeah. So, and as you see, their FFO is growing, their property count's growing, their dividends growing. So yeah, I like that one a lot.
Yeah. Cool. Blue Collar Bill, what's up, man? He likes DLR and store picks. Own both in his Roth. Yeah, I don't own DLR. That's one that I would like to. Like I said, I think we should start thinking more about the digital space. All these YouTube videos got to go somewhere. I mean, where's they going to start? They get billions of hours uploaded. Let's see. We did MPW, IIPR, and OHI. Interesting one. I do own OHI. I own, I think, like 117 shares or something. I did it because I bought them around 36 to start selling covered calls on because they had a higher dividend, and they've been having some issues, and they haven't cut the dividend yet. It's pretty much been frozen. They're not raising it anymore. Do you own OHI, Omega Healthcare Investors?
No, I don't. I've looked at it for a long time, being a dividend investor. The yield has been great, but the extended care type of facilities that they do is just not an industry I'm personally comfortable in. And obviously, COVID did a number on them because the assisted living facilities were a perfect breeding ground for COVID transmission. So they've had it really hard over the last few years. But
Yeah.
so, yeah, I've always stayed away from it just based on what they do to skilled nursing facilities and assisted living. So I don't really have a lot to say more than surface level stuff on this one.
Yeah, I think a lot of us are thinking that with the baby boomers retiring, that it's going to be, that there's going to be a lot more money coming into this area and this sector with the skilled nursing and assisted living. So yeah, the baby boomers, they got a bunch of money and they're all getting older. So, but we'll see. I mean, that's the AFFO that's down. 74% occupancy rate. I like this. Yeah, this is nice. I like this site. This is really easy, quick and easy to look at, showing their occupancy rate right there at 74%. So that is definitely a concern. And I think that is one of the reasons why a lot of, the market is kind of punishing them. I think that's really interesting. So yeah, that's kind of another one. Invest at your own risk in that. But yeah. And Steve was talking to Adam, said, is MPW Capital Mindset. I don't know what Capital Mindset is. Is that a YouTube channel or is that? Oh, it must be in his REIT video. That's interesting. There's so much information. I love it. Yeah, I guess I don't have to put those up. If pot is legalized, that will hurt IIPR and other risk.
Mm-hmm.
I don't know. I mean, I think if it's legalized, well, I guess the risk that I might see as I'm trying to think about this is on a large scale, they're going to really need big places to grow marijuana if it's going to get national distribution and just be grown everywhere. But I still think like a Philip Morris or an Altria, they're going to just swoop in, right? So I don't know. That'd be my guess. But do you think that would hurt them if they're regulated?
So it would hurt IIPR, sorry, because there'll be other lenders available to these facilities. But it's going to be a positive thing is there's going to be more cannabis, more medical marijuana out there once it is federally legalized. So IIPR has the opportunity to expand to new states and new locations if it is legalized across. And so a lot of the tenants, they do long-term leases, as Russ was saying at the beginning, 10, 15 years. So even if something was passed over the next few years, it's going to be another decade or so before these leases are renewed. And at that point, they might have to lower the rates because there's other competitors offering them things. But I think we have a long runway for that. And in the meantime, they're going to continue to buy up properties and get bigger and bigger. And they're going to be basically the 800-pound gorilla. So even if a bank like Chase or Bank of America starts lending, they're still going to have to compete against IIPR. And also a lot of these medical marijuana places don't want to necessarily own their building. They want to do the production. And so by offloading the building to a REIT, they get the cash infusion and they don't have to worry about the upkeep of the building. So that's another thing that a traditional bank won't be able to do because they're just going to lend you money so you can buy the building. But a lot of these facilities, the processors don't want to actually own the building. So I think there is risk for sure. You have to keep a watch on this one, but I don't think it's going to be as bad as the headlines say it's going to be.
Yeah, and I think FOMO works both ways, right? So I think with IIPR is just a lot of people just the FOMO go in the opposite direction. And yeah, like I said, I'm not going crazy with it. I'll probably add 2 or 3 more over the next month or so, but I mean it's risky. It's risky like anything, and I guess is it a sin stock? I don't know. I guess it probably is considered a sin stock now. I don't know. I mean, if tobacco is a sin stock, then
it's tough to know because IIPR doesn't produce the cannabis.
Building,
so it's hard to. It's one of those gray areas, I guess.
Yeah, but great points, man. Great points. Again, blue collar bill. I think a lot of people are averaging down in IIPR. So yeah, I'm also looking forward to their August. I think it's August, their earnings report to really kind of get a little bit better feel on what's going on and what management's direction is. And I know they refuted a lot of the Blue Orca short report, but some of it came to pass. So, we'll see.
The way I look at it,
yeah, we did.
It's one tenant, and they quote unquote defaulted, but they're still in negotiations. So IPR might be able to get most of that payment back. It might just be delayed or a slight reduction. And it was a very small percentage. I calculated the other day. I think and these numbers might be wrong, but it's something like $228 million in revenue for IIPR. and this was like a $2 million worth of rent. So it's a very small percentage.
Yeah.
But I think just it shocked a lot of people, and that's why we saw the reduction in the price recently.
Yeah, with King's Garden, I was just trying to look it up real quick, see if I could find that number. Yeah, it was their 5th largest tenant, and it accounted for 8% of their rent last year. So not ideal, but it's not going to crush them. But yes, so yeah, you're welcome, Michael from Sweden. I think this is so cool. I'm here in my house talking, and people from Sweden are listening. It's awesome. Cena 896 says ADC. Yeah, I agree. Realty. So I just did a bit on them in the last video in 4 monthly dividend stocks that get a safe rating from Simply Safe Dividends. And yeah, I talked about ADC. They're very similar to like a Realty Income, a lot of overlap with retail tenants. And they have kind of like, it's like a who's who. I think I made the joke. If you look at their tenants, their national retailers, it's like try and find the logo that you're not familiar with. I mean, they just have a lot of solid companies. And let's see. Yeah, MPW. I was like, hey, look at somebody said allreits.com. Well, that's me. Yeah. This guy. Let's see. Rio. Oh, that's interesting. Rio can. Yeah. They've popped up on a screener before. I don't invest, but Rio, that's one of his Canadians. Yeah. So Smart Centers. Immediately, I'm like, dude, they spelled center wrong. But I think that's how the Bell Center, where the Canadians, where the Habs play, is spelled the same way. Cool. Here we go. What do you think of Verizon after the price dropped? I bought more. I'm gonna buy more. They're gonna be okay. There's really triopoly, maybe, right here in the U.S. between T-Mobile, Verizon, and AT&T. Interestingly enough, I put out a tweet because I compared the 3 on Seeking Alpha, and T-Mobile over the last 10 years, including dividends, has blown. Now they don't pay a dividend, but they've blown away Verizon and AT&T. So that's kind of interesting, for us dividend investors that preach income. But yeah, I'm still buying Verizon.
Yeah, I have a big position. I'm not actively investing more. I'm just letting the drip happen. I mean, it's great high yield and very low growth. So it's kind of one of the just stable ones that you just put in the background and collect that dividend, but you're not going to see a lot of growth with that one. A lot of people compare it to a bond, if you will, an equity bond.
Exactly.
So, yeah, but I mean, they have so much free cash flow. They have so much revenue coming in. They're as you said, one of the top 3.
So they have a dividend safety score of 87, so they're confident in them being safe. Yeah, you can see I have 47 shares at $54 a share. So, I'm down a bit. I'm just going to average down. I'm not terribly worried about them, but yeah, their dividend growth slow. I mean, 3% CAGR over the last 20 years, but it's usually a bit higher yield. So 15 years dividend growth streak, 31 years, they haven't missed the dividend payment. And I believe 31 years might be when they came into existence. I don't remember the tree. There's a funny tree that shows the breakout from everything that came from the baby bells. So Verizon came from AT&T. It's like they blew apart the blob, and the blob slowly starting to put itself back together. And let's see there. July, they just went ex-dividend. So, it's going to be there. The money's, the dividend yield's 30% above their 5-year average. And they are just, again, squarely at the low end of their 52-week range.
So are a lot of companies right now, unfortunately.
Yeah.
Another way to look at Verizon is almost like a utility. With the amount of people who have cell phones and things like that now, it's almost a necessity. So it's always going to be there in the background. They're always going to have that cash flow coming in. But, it's already a mature market. Everyone has a cell phone. No one's really going to be adding a ton more. So they're only going to grow with the population growth. There's not much more to it.
Yeah. Nice. Got Ryan Williams checking in. What's up, brother? What's up, punk? So, we chat a lot off, trying to figure this YouTube thing out, talking stocks and whatnot. So, Vale, right? That's the oil company, I think. Are they, or mining? Let me look up before I start just throwing things out there. Here, look this up. I'll put it on the screen here. Yeah, Vale. Oof. Iron ore, that's right. I knew they were something steel. They don't, here, let me share the screen. They don't have a dividend safety score. I know they're foreign.
Yeah, they're from
Oh,
Brazil.
foreign for me. I mean, that's
Yeah,
non
it's from Brazil.
US. Yeah, 17% yield. Wow, 100%, 111% dividend growth. Large cap, $12 a share.
What's the payout
Yeah,
ratio? I'd love to see
let's
that.
see. Says 70% for the free cash flow payout ratio.
Yeah,
So, wow, well, that's
it's
some
very
of this information.
very
Looks a little,
cyclical though. You see it coming up and down a lot, so you got to be on the right side of this
yeah,
this trade. Wow.
yeah. That's they've been buying back shares. So they were at 5.20 billion in 17, and they're at 4.93 billion. And sales have been, for the most part, going up. Yeah. So right in 20 and 21, just a lot of money, a lot of 294 billion in sales. Yeah, let's see if they have their debt. Yeah, 19% net debt. I don't know. Yeah, I think Jeremy's right. They look okay right now, and I don't know how much currency, like the FX factors into this, but
Yeah, anytime I see a 17% yield, you just have to start wondering if something's wrong because,
it,
generally speaking, if the market goes up 10% a year on average and it's paying 17, what's going to happen to the share price? Is it going to go down that 7% on average? So you got to really be careful with high yields.
Yeah, it makes me nervous too. Like I know they have a lot of 4.9 billion shares, but when you see that $12 a share and it's such a high yield, why isn't everybody and their mother piling into it? It's just interesting. I mean, maybe a few shares just to what the heck, but yeah, I wouldn't go anything big. So Bill sold out of OHI for a slight profit. Yeah, I've actually thought about that, and it's hard. They keep me in with the dividend. They just declared another dividend, and I keep thinking every time I get the 67 cents, I think it is. So I'm getting over $67 a quarter because I have, let's see, I have a good amount. So yeah, they have a dividend safety score of 40, which is unsafe, 8.74% yield. I have 107 shares, bringing in $286 a year, but it's 6.4% of the portfolio, the three portfolio income. So it's a little bit high, and I've thought about scaling back or trying to sell a leap, like just sell a leap to get out of it. But we'll see. My luck, I'm going to sell a leap, and something crazy will happen, and they'll go up to $50 a share, and
Exactly.
but yeah, I actually might do that. I might sell like a year-long leap on it just to get some money and collect the dividends in the meantime. And if I get called out on it, I do. So that's something I'm going to put on the list for this week.
Another way to do is maybe turn off the drip and use that money to allocate it elsewhere. So you're reducing your percentage, but you're still getting that dividend in the meantime, but you're not adding to it necessarily.
Yeah, so I don't drip. I don't like to. I always make the joke I collect the dividends and then I cut them with new cash and I target, allocate, reinvest. So I don't drip. I haven't added. I don't remember where the 7 came from. I think I was trying to average down and then I stopped doing that. Any opinion on WP Carry, combination between Realty Income and Stag? I've seen them. I've never really dug into WP Carry. I know they're on a lot of lists. Do you own them? Have you dug into them?
I have a big position. I've owned them for a long time. What I like about WP Carry is the diversity. They have properties in all kinds of different industries, and they're international, so they're literally all over the world. So I like them in that aspect. Super high quality company. The only downside is their dividend growth is basically nothing. So whatever you have right now is basically what you're going to get. So as you see, 1%. I don't even know if it truly is 1%. It might even be less than 1%. But it's a quality company. So they've been doing it for a long time. They're super diversified. I think I have somewhere in the 100 or 200 share range. So I have a pretty large position in it. But
wow. Yeah, you sell calls on that?
Not usually, no.
Yeah.
Yeah.
So the dividend yield is 11% below the 5-year average, and the price to AFFO is above. So yeah, they're definitely not on sale. They're toward the higher end. They don't move much, $73 to $86. So they're at 83. So kind of the higher end of the 52-week range. But yeah, I think Jeremy covered it. I don't invest in them right now, but yeah, they look pretty solid. Yeah, Bill. It's his largest REIT too. Solid, stable REIT, but not great growth. Yep. There she is, popping in again, Caitlin, waiting for swing trading VZ. Yeah, I think I want to try and get to 100 shares of them so I can start messing around with some options on them. About 40% of the position. Buying the 40s, selling the 50s, rinse and repeat. I love it, man.
Yeah.
I love that. Yeah. Buying the 40s, selling the 50s. Yeah, I know I'm nervous with Pepsi because I've been seeing Pepsi go to like the low 170s and then down to the high 160s. So I've been tempted to do that with Pepsi, but I just know when I do, they're going to go to 180 and I'm going to get them. Yeah. So I don't really want those called away. I spent all that time and I'm up a couple thousand. I think like 150 might be my average on those. So if I were to get them called away at 170 or 172, now I got to pay taxes on that big capital gain. So I'm bringing in less premium with Pepsi by, very, very gingerly selling very low premium, anyway.
Well, I always say that you can double your dividends with cover calls, especially if you do it far out of the money. So if it's 170 now, maybe do something in the 192 range, 190 to 200 range. And at that point, you get a little bit of premium, but you're not at risk of losing your shares.
Sorry, I missed this. So Steven with a super chat. I must have missed the alert, but yeah. So thank you. Steven just contributed $5. I do appreciate that, Steven. Thank you so much. And he would like to know he's got 500 to spend, Intel or Verizon. Well, you want to go first or you want me to throw my, maybe I'm the host. I should go first. So I think if you're looking at stability of the dividend, I would probably go Verizon. Like we covered, they're kind of like a bond proxy. But if you want to go for the upside and swing for the fences, I would definitely go Verizon because we've got the bill. I thought they were supposed to vote on the CHIPS Act last week. This is the way our government works here in the United States. We won't get into them, but a vote is going to be forthcoming. It's billions of dollars on basically producing chips here. They want to invest in companies like Intel. And let's see what Intel is. Let me share the screen for you. Steven, since you were incredibly kind to drop a $5. Let's see here. It's going to be on WPC. So we go. I do own 100 shares of Intel. I'm a little bit down on them. Yeah, they give them a dividend safety score of 80. $39 right now. So 5% dividend growth. That's not too bad. I look at it as getting paid to wait. And yeah, you can see me. So I sold a cash secured put on Intel at $47. And it's just been getting crushed with all of the chip stocks, all the semis. So I'm down to like $1,000, but I'm not worried. I'm just going to hold them. And let's see. So their dividend growth, a 15% 20-year CAGR is pretty nice. It's up and to the right. And that's weird. 7 years of dividend growth. So I don't see where they froze it. Apparently they were frozen. That's weird. Sometimes Simply Safe Dividends isn't always accurate. You should always not take everything here.
You look at
that's gospel.
2013 to 2014, it looks like it was flat.
Yeah, there you go. Right. Yeah. Which is probably about 7 years ago. This is my public school math coming into play. So, 36.5 cents a share. And they go dividend, ex-dividend in 11 days. So anybody that's thinking about Intel want to pick up that next dividend of 36.5 shares. The dividend yield is 48% above the 5-year average. So that's stout. They're definitely on sale. And they had been as high as $56 at $39 right now. And let's see, we'll go a little bit more in depth for you, Steven. So free cash flow, 58%. That's not terrible. I think it's interesting that Simply Safe likes to see below 50%. A lot of us, I'm sure Jeremy knows, in the dividend community, people are kind of torn between 60 and 70%. They want to see under, so there's room to grow that dividend. So 58 is high for them, but not anything crazy, I don't think. And free cash flow per share has dropped a bit. Earnings per share we see dropping. Yeah, choppy sales growth, but their total sales had been rising, and they're buying back shares down to 4.09 billion. Yeah, I like what Pat Gelsinger's doing. I know people are mixed on him, but good free cash flow margin, I think, even though it's a little low for them, still 11%. It's above what SSD likes to see at 5%. And yeah, I don't think this is right. This shows zero net debt. I don't see them as not having any debt. So anyway, I think that was a long-winded way, I guess, of saying that I would definitely go Intel if you are looking for some upside. What about you? What say you, Jeremy?
Yeah, so I own both of them. VZ is just a long-term position for me, and I have to preface this, but my timeline is much shorter. I'm looking at 5 to 10 years max before I start using my dividends. If you have a much longer time, obviously we don't know how you are, Stephen. But for the long term, if you're looking for dividend growth over time, Intel is going to be the way to go. But for me, it's VZ because I need the current income sooner. So I own both. I have Intel. I do the wheel with, so I do calls and puts on. And right now I have 300 shares of Intel, but I'm just wheeling it, so I couldn't care less if it gets called away. The only issue I have with Intel is obviously they used to be the leader in the space, in the chip space.
Yep.
But looking over the last 10 years, what's happened? You got AMD, you got NVIDIA, you got all these other companies basically eating Intel's lunch. So you really have to do your research to understand, will Intel get back to the top? If they don't, I think the stock's going to continue to go down.
That's kind of what Pat Gelsinger, he's mentioned that he wants them to be the leader again. And that's why he's building the foundries. He wants to be the chip maker once again. And he wants to make chips for even the competitors. So he's got a really big vision, which I like to see. He's thinking really big, but if that comes to fruition, that's a promise from him. So I don't know. There's risk for it. There's a reason why they're, a lot lower right now. So, all right, let's see. Again, thank you, Steve, for that. Ben, have we talked about Prologis? We haven't. I haven't really dug into them that much. I know that, like I said, there's a lot of Prologis buildings around the Chicago area that I visit as a subcontractor for them. So they're, it's industrial spaces. I mean, we're always going to need that. And I don't know. Do you have? Let me see what they get. What is your thoughts on Prologis? Do you have any?
I don't own it. No. I believe they're industrial REIT, and I just focus on other ones like the IIPR, the Stag, and whatnot. Just haven't ever gone to Prologis.
Yeah, real quick. 61 dividend safety score. Looks like they cut during the last recession. Yep. 8 years of growth. 25% increase in February. That's pretty stout. But yeah, they're 20-year. They're factoring in that big cut during the last recession, which a lot of people think we're headed toward a recession. So if that's the case, they may cut again. And their ex-dividends already passed. So they're about maybe a little bit on sale if you like them. So I don't know. I don't think I would. I would probably feel better looking elsewhere. Their dividend yield's about 2% below the 5-year. So yeah. Caitlin, I love it. Pepsi's my baby. Don't swing trade your highest conviction picks. See, I'm telling you, Caitlin, she needs to come on and chat because she has a ton of good information. She swing trades VZ. She doesn't believe in the business. Nice. Yeah, that's awesome. I love to be challenged. I love everybody's different thoughts on stocks like that. And like you were saying, it made me think with Intel being part of your wheel. I want them to be a wheel stock, but what do you do when you're so far down? Do you just wait, or do you just kind of take your losses and then use that for tax loss harvesting to get out of it?
So the way I do it if I'm down on a wheel is I look at the oh God, I can't even think today. The percentage chance of getting it called away. So even if it's for strike prices under my cost basis, if the percentage chance is real low, the delta, that's what it's called. If the delta is low, I'll go ahead and do it just to earn the income, taking the chance that it would get called away. But that's what I do is let's just say I'm down 20% or something on a stock, I'll do it maybe 15% under my cost basis to get some of the premium, and then just hold on to it until it goes back up.
Yeah, I might. I'm going to think about doing that because, like I said, I'm basically on the 100 shares I own $47. So I kind of want to have 20 shares or so of Intel, but those 100 shares I wanted to do the wheel on them, and then I just got caught as they started getting crushed, and now I'm I was almost like $10 a share down. So I might do that. but the premiums are low for weeklies. I mean, I'd have to go out a little bit more, but yeah, I don't want to tie this in with what Caitlin said again, is that she doesn't think she would jump out in front of Intel's earnings, that she thinks they could disappoint or lower their guidance. So, or pull a guidance altogether. Yikes. If they do that, then I don't know, that they're going to get slaughtered.
Yeah.
I mean, we might see $30 a share if they pull guidance. So now you got me thinking, Caitlin. She needs to write a blog or something. She has so many good ideas. It's, but she won't come on the channel. I don't know why. If you it's invitations out there, if you ever want to, and just chat, we could talk options. She knows a lot about options. The market's going down. There's a big risk not to invest. Yeah. It's funny, Michael, that a lot of times the best time to invest is in recessions, because not only, especially for dividend stocks, but I mean, all stocks, they're lower. But when dividend stocks go lower, what do we get? Higher yields. So I know that right during the Great Recession in like 08, 09, I know there was a lot of companies with yields that were 6, 7, 8% because the share prices were so far down.
Absolutely.
So
money's
good.
They say.
Absolutely. Interesting one. We'll do a few more here. What's the safest dividend stock with low beta to park money for 1 year? I'm going to look at this one. I mean, do you have any thoughts off the top of your head? I'm plugging one right.
I have thoughts on thanks for the question. My general thought is, if it truly is only a year, don't invest it. That's my advice. Anything can happen in a year, even on a low beta stock. It really, if you need the money in the next 3 to 5 years, it's probably better not to invest it. But if you are investing, I would definitely go with either an ETF like a SCHD or BYM, or one of your high quality ones like maybe a Church and Dwight, a Johnson & Johnson, something along the Procter & Gamble, one of those more stable companies where you're not going to get a lot of upside, but hopefully you don't get a lot of downside. And so that's where I would go. But again, if it's truly a 1 year timeline, I wouldn't do anything with it.
Yeah, but if you absolutely had to and you're crazy and you wanted to, I would probably, here you go, Procter & Gamble, exactly. a beta of 0.43. So for those that are new and might not know, that's just a measure, I think, of volatility. I'm trying to think how to explain this. So if the stock market moves up, $1, then Procter & Gamble's only going to go up 43 cents. But if the market drops $1, they're only going to drop 43 cents. So not a lot of volatility on Procter & Gamble, and dividend safety score of 99. So that would be my pick if you wanted a low beta stock to park money. And let me see their 52-week range. So $132 to $164. They don't really move that much, and they're almost in the middle of that, toward the lower end. So yeah, but that's a good thing. If you need money within a year, just keep it out of the market. Yeah. So, well, I don't know if anybody's got anything. One last question. We'll hold the floor up for just a second here. But yeah, it's been fun, man. It goes by quick. I hope we started off. People got some good info on our picks. And what do you think about the data centers? Is that kind of why you went DLR, right? I mean, we need more data. There's more people, more devices.
Yeah, exactly. And I mean, you hear all this stuff about the Internet of Everything. Even your dishwasher can be attached to the Internet, at this point. And so all that data and all that transmission has to go to somewhere. And so places like DLR are going to be the ones facilitating that. So I only see positive things going forward for them. But again, I'm very diversified. I have REITs in almost every category. I have stocks in almost every category. So I don't necessarily like betting on one particular industry. I usually keep it at 10% or less for each industry. But yeah, data centers definitely somewhere to look into.
Yeah. So again, I don't, if you're an absolute beginner, I'm mixed. I know there's debate on what to invest in, and people, say like you should just do ETFs or total market funds until you're ready to do individual stocks, but you don't learn as much. Like when you just buy like a VNQ, it's cool. You get exposure to 170 REITs, but like you said, you're also getting you don't learn, I've learned some of my biggest lessons from mistakes and doing things wrong. And hopefully I don't repeat them, right? Because what do they say? The first time is a mistake. The second time is a choice. So, I don't know. But
Yeah.
There's so many different ways to invest. You got to find your style, what suits you best, and just get in there and do it. Just do it.
Yeah, definitely. ETFs are great to start off with. And even, I mean, if that's all you ever want to do, that's perfectly fine if you don't want to get involved in the details. But what I've also found is you don't have as much conviction if you're just buying an ETF because you don't feel that ownership of the individual companies. If you own a company, you're more likely to follow it more and get more details. So I find that it's easier to stick with companies that you really like. Oh, thanks for the shout out there. I appreciate that. Yeah, so I run a blog about dividend investing. So my goal is to provide insights, inspiration, and ideas when it comes to dividend investing. So we do a weekly undervalued dividend stock post. I do some dividend king threads, a bunch of different things that have gone on over there. So yeah, I appreciate that.
I'm sharing it. I should have done this before. There we go. Yeah. So
Yeah,
what'd you do?
I'll
Undervalued.
43 undervalued dividend stocks you can take a look at is that first post. I also
Yep.
do like a little market commentary where I talk about what's going on in the market. So yeah, appreciate it, guys.
Dividend Kings. Yeah. Definitely check out Jeremy's blog, dividendstockpile.com. And I think that's probably going to wrap it up. Let me just see here. It's crazy. I'm always ready to get off and then somebody pops something on and, oh, that's interesting. Where did our names go? Because we had our names there before. Oh, when I put comments up, they go away here. So I don't know what I'm doing here. I turned my comments off. This guy's out of control. I don't have it. Yeah. Anyway, there was our names were on the bottom for our tags, but there we go. Here, last few more. We'll go into extra innings for just another minute because I don't want to get these too long because I'll just talk for 2 hours. Here, Clown said he wants all the rewards for individual stocks, but he knows it takes all the risk. Yeah, great point. Don't chase yield. Everybody has stories about chasing high dividend yields. Yeah. There you go. ORCC, chasing yield. Steven, don't worry. I think I did a video like a year ago on yield trap stocks, and I believe ORCC was my number 1 or number 2. I think AGNC was the top one for yield trap, but yeah, ORCC is one of them. And then there we go. I think we'll wrap up with Caitlin's comment. Highfields shorted DLR famously to disastrous effect, and now kind of Ghost Associates is shorting them. People don't understand the tenant relationship DLR has and the value proposition they offer clients. You see, this is what I'm saying. Like, Caitlin,
where can we find you? Put your info in there. We'd love to follow you.
Yeah, put your info. What's your socials? I mean, she won't come on. I want to have her talk about stocks. She's probably more knowledgeable than I am here. I can learn some stuff, but yeah, and that just shows when I see that people that make a lot of money and handle a lot of money and are in the know, sometimes they get wrecked. So I think the takeaway is this is good because nobody knows what's going to happen. Not even Warren Buffett knows what's going to happen. He's just been playing the game a long time and he's seen a lot of things. But even him, I mean, he was wrong on what, Delta, right? Was it Delta? He says he never buys airline stocks, and then he buys Delta, and then COVID happens, and then he blows out of it right away at like its low point.
Same with IBM. He bought IBM, and it did nothing for him. He ended up selling it too. So
yeah.
He doesn't get them all right, even though, I mean, I love him and I follow him. Caitlin. So back to your point about not chasing yield is one last thing. When I look at dividend stocks, I look for a total combined current yield plus dividend growth of between 10 and 12. That's the sweet spot. So let's just say you have a 3% dividend with a 9% growth. That's 12 when you combine them together. That's a really good starting point when you're looking to see if you're chasing yield or not. You can have like a 7% current yield growing at 3%. Okay, that's pretty good. That's in the 10 range. So that's kind of where I found that is the best way to approach it. Kind of middle of the road, 10 to 12.
Yep. Yeah. Good stuff. So, well, if Caitlin doesn't want to share socials, that's fine. Hey, I'm an introvert. If I can do this stuff, come on, anybody can do this. I swear to God, I am. So it's funny. I'll just say real quick, when I'm around people like out that I don't know very well, I'm super quiet. I don't it's so hard for me to talk to people and break the ice. But yeah, see, Steven said he'd follow Caitlin. Caitlin, if you want some followers, let us know where we can follow you. I don't know if she's on Twitter. I was telling Jeremy before that I saw her somewhere, either on Twitter or Insta. No investing focus socials. Hey, that's cool. That is cool. And well, thank you for swinging on by, Caitlin, and sharing your knowledge. I look forward to it. Very, very, very knowledgeable, and keeping things on the down low. That's fine. We can respect that. And then I'll wrap it up here. We'll wrap it up with, I don't want to give his name away. This is another YouTuber that is in the Chicago area. I hope that's not revealing too much. Maybe it is. If it is, I'm so sorry. But we've talked on Instagram, and we're eventually going to do a collaboration video or live stream or something of some sorts. But anyway, so Citizen of the Year, follow this channel here. And Jeremy again on Dividend Stockpile. If I can share that real quick. Yeah, so check him out. And it was a fun chat. We'll definitely do it again. I get a little bit lazy, and because I have to contact people and then set up the stream and share it. It's really not that much work, but I get lazy. And then anyway, so
thanks for having me on.
Nobody cares to hear that. But so for me and my Return of the Living Dead shirt, I am a horror movie fan and buff. I love horror movies. We're going to end it right there, and we will say thanks, everyone, for... Okay, so this made me feel better. Just, yeah. It's pronounced like Cody. Yeah. Okay, good. I always worry about that because my guy, European Dividend Growth Investor, I did a live stream with him on their podcast like a year ago, and I learned, like some not proprietary. Anyway, information he doesn't want out there, so I never know what. But that being said, make sure you follow Jeremy at Dividend Stockpile. And I've been Russ, and I'll see you guys in the next live stream. So long, everybody.